Hello, welcome to the sharpening session today. Now, I'm just going to put the disclaimers up there on the top left-hand side. So please read them, even if you need to pause the video to do so. Now, I'm just going to show you different places you can go for help and resources. Then we'll crack on with the sharpening session today. The sharpening session today is going to be based on risk management. And more importantly, I'm going to give you on different topics what you might do if you're risk averse, what you might do if you're more risk comfortable, and what you might be if you're in between that. So that's the main topics that we're going to go through today. We'll get into that in just a second before I explain different places you can go for help and resources. So you have my email address, just about, I think you can see it, becky@tradewithufos.com. So you've got that. Now you can obviously email me on that, but otherwise, if you go to tradewithufos.com/Becky, you'll come to this link here, this page. Now from here, you can do loads of things, some of which are resources that are paid for, some of which is help and support that's free. So for example, you've got one-on-one coaching that you can book. That would be a paid for thing. Apps, some of which are free, some of which are paid for. Courses and coaching, live trading, and some courses login areas. Now, if you scroll down, you've got this, which is again uploaded for free, which is all the sessions that I do live and all of the stock trades, Forex trades, or crypto trades that I place. You'll see them all in here. Now, if you scroll down further, you can learn more about the different apps that we have. Scroll down a bit further, learn more about the platform that we use, our platform. And if you scroll down even further, again, a free question and answer section where you might learn from the questions that other people have asked and the answers that are there, or you might need to ask a new question again for free and we will answer it there. So lots of help and resources all from the same area. Now let's go through and talk about what we're going to talk about today. So this is my very rudimentary menu slide, I guess, that we're going to look at. But essentially, we're looking at risk management. Firstly, as an overview, what does it really mean? What would we really recommend kind of as a general basis? Then talk about the different percentages of risk, depending on your comfort level with risk. We'll then look at what you would do in the case of extra volatility, which is one of the reasons why we go through volatility on the 3D market commentary that we do every day. So I'll talk about that, what you might do depending on where you're at on that spectrum, what you might do if you have correlations, so trades that are correlated together, what might you do if you are more or less risk averse, and then what you might do with your rules, obviously based on the methodological rules that we are using. How lax or strict might you be? What extra rules might you have or not? Again, depending on where you're at on that risk management or risk comfort levels, risk averseness spectrum. So I'll give you different ideas from that. Now, those of you that might be here with me live, just let me know in the chat box if you have other questions. I'm happy to divert to make sure you get your questions answered. Otherwise, we should be okay to be able to get through our hour with this content. So let's give a quick overview here to start. Now, the overview here, and I'm just going to put this in big, big, big capital letters. Always, always, always use stops. That's our general, deleted accidentally, but let me do that again. Always, always, always use stops. It is imperative that we do that, no matter how risk comfortable we are, risk averse that we might be. We will always need to use stops. And why? If you're not using stops, you are essentially saying, I think I'm right. I think I am 100% right. I know better than everybody else in the markets. Can't possibly go wrong. That is, of course, a recipe for disaster. Even when we're investing, even if it's longer term and we're okay with those small dips, fine, on the way up, then we just place our stops in a different place with a bit more wiggle room behind different UFOs on different time frames. But we don't just not use them, because then what happens if we get in at the top of a market and it halves in value, and it takes 18 months to half in value? It takes another 10 years to get back up to the same place that we were in. You're going to be at a loss for 10, 11, 12 years for the sake of not using a stop and getting out maybe at a 2% loss or 5% loss or a 10% loss. as opposed to a 50% loss that drags on for many years by the time that you can get back to even break even, let alone profitable. When you factor in inflation in that time, you'd need to go even longer by the time you would break even or be profitable. So even if we're long-term trading or investing, always use stops. Otherwise, you are at risk of losing your entire account. Especially this is true when we're trading leveraged assets. So if you're trading futures or Forex options, even more important. Now, we would say, even if you're trading stocks or cryptos, I guess, even if it's not leveraged, still use stops, because they can still halve in value quickly, especially in the case of cryptocurrencies. But with leveraged assets, this is even more important, because perhaps, let's say you've got 10-to-1 leverage, the market drops by 5%, your account's dropped by 50. So we need to be aware of the fact that in leveraged assets, stops mean that we protect our account even more, because we're obviously in the position at multiple times what we're actually using in our account. You might end up getting margin called. You might end up being taken out of trades anyway by your brokers because you haven't used stops. So just always use stops. Now, where you place stops, that's the question. A lot of people might say, well, if I use a stop, let's say, for example, let's just take UFOs off here for a second, just to have a nice clean chart, kind of make up the where it would be. Let's say, for example, you bought right now, and this is obviously a continuous chart, you wouldn't trade on this one, but for argument's sake, let's say you bought right now at 4280.75. You might have a rule that says that your stop loss goes beneath the last pivot, which could be around here. Could be based on patterns, based on different types of zones. So it might go beyond this one. It might go a certain percentage of whatever the price is. Might be 1%, might be 2%, might be 0.5% in terms of the price of the product itself. It could be that you put a stop a set amount of ticks away, or pips away, or cents away, depending on what you're trading. So we're all going to have different rules. You might use Fibonacci retracements and say it's the next Fibonacci retracement down. You might use moving averages and say, if it crosses those two lines, then I'd get out. You might have stops that are based off of time, right? If I'm in the trade for more than a certain amount of time, I automatically get out after 5 days or 5 minutes or 5 years, whatever. So loads of different ways, different theories as to where to put stops. To be honest, I would personally argue, doesn't even really matter what those rules are, providing you have them and you are consistent with them and you have back tested to prove that overall that works out well for you. Now, a lot of people might say, well, when I use stops, let's say you get in here and you put your stop at 42.50, that if price drops down, might go to 42.49 and then move up. So whenever I use stops, I just get stopped out. Otherwise, I would have been right. What that says is that you're putting your stops in the wrong place. Stops should be there to protect us when we're wrong. If we're getting stopped out even though we're right, which still might happen very occasionally, but if that's happening consistently, it's not the stop that's the problem. It's your strategy as to where you're putting it. So play about, find a different place to put it that protects you in the case of being wrong, but keeps you in the trade in the case of being right. And that might be, instead of putting it 10 pips below, you put it 12 pips below. Instead of putting $1 below a stock, maybe it's $1.50. Instead of it being a percentage of 1%, maybe it's 1.5%. Instead of it being at the first pivot, maybe it's at the second pivot, whatever. You might just have to move things around a little bit to protect yourself in the case of being wrong, but still be in the trade in the case of being right. If you're getting stopped out even though you're right, meaning price did go in that direction, you got stopped out, price moved down by a couple of pips, a couple of ticks, a couple of cents, then went off from there, your stop was in the wrong place. Not that the use of the stop was wrong. So I come back to my main and pivotal point here. We always always use stops. If you're finding issues with getting stopped out too often, despite being right, then backtest different places you can put your stop in. That would counterbalance that unfortunate thing happening, right? Okay, so that's the overview done. We've done this. So we know, oh, I can't do the little cross out thing. I was going to cross it out, but we'll just put it in red. We've done that. We always use stops. So now let's talk about percentages. What percentage of your account are you willing to lose when you're wrong? And therefore, that's how you weight the difference between your entry and stop. So what I mean by that, and I'll come on to a different sheet here. In fact, we'll do it on here. If you are, this is our general rules, if you are risk averse and or new to trading, then you should be risking 0.5% up to 0.5% on your trades. That's the general rule. If you are the opposites, we'll put this over here. If you are risk, I don't know what the opposite of risk averse was. There's obviously a phrase for it, but I can't remember it. But risk comfortable, risk, I don't know what the word would be. The opposite of risk averse, right? So if you're the other side, then we would again argue, and this is also true, so risk comfortable slash more experienced. So if you're in that category, then you would be risking up to 2% of your account. Now you might be thinking, sorry, this is the other end of the spectrum and it's only 2%. Well, think about it. If you're risking 2% of your account on every trade, all right, if you're trading once a year, maybe not, but for most traders, as opposed to very, very long-term and passive investors, if you are a trader, you might be placing 10 trades a day, 10 trades a week, 10 trades a month. Let's say you're risking 10 trades a month. You're placing 10 trades a month and you're risking 2% on every trade. You could lose 20%, 1/5 of your account in 1 month if you're wrong on all of them, which can happen. You can lose 10 trades in a row and still have an overall good strategy just because the way that works out. You could have had, in theory, 10 losing trades and then 10 winning trades. And maybe you risk 2% to make 5%. So still over the course of 20 trades, you're very profitable. But over the course of 10 trades, you could still really damage your account if you're risking 2% every time. If you want to go above that, let's say you want to risk 5% and you're wrong 10 times in a row. You lost half of your account, which means your buying power is half, which means your psychology is affected a lot. If you lose half of your account in a month or in a week, that's going to affect you. It's going to make it difficult for you to continue to place your trades and follow your methodology. Even though we all know logically, the roll of the dice could be that you happen to get 10 losing trades in a row and then 10 winning trades in a row. Overall, that's a 50% winning rate. But it's not going to work out 1 win, 1 loss, 1 win, 1 loss, 1 win, 1 loss like that, like clockwork forever. You're going to have periods of more losses, periods of more wins that overall give you a profitable percentage. So if you're risking so much per trade, 5, 10%, you could be in a position where you blow up your account for just bad luck going through those few losses in a row. That's why even at the more, again, I can't think of the phrase, but the more risk tolerant, that's the word, risk tolerant. That's come to my mind now. So even at the more risk tolerant end of the spectrum, we'd still say no greater than 2%, which means somewhere between, and I'm just going to put middle here, somewhere between these two, you're going to go between 0.5% to 2%, right? So it might be 1%, 1.5%. In fact, maybe let's put that 1% to 1.5% just to make it obviously clearer here. So yes, you might be risking, say, 1% of your account if you're in the middle, meaning you might be reasonably experienced and or reasonably risk tolerant. You might be extremely experienced, but be risk averse. Fine, be in the 0.5% category. Now, you might be extremely risk tolerant, but new to trading. I would say you might be extremely risk tolerant, allow yourself to become experienced before you go towards your risk tolerance end of the spectrum. Because if you make mistakes as you're learning, it could cost you bigger, right? You want to risk less if you're making mistakes as you're learning. Once you've then caught up and you know what you're doing and you're consistent with your behavior, you've got a trade plan that's working for you, you back tested it, you know what you're doing, great. If you're risk tolerant, go towards the other end of the spectrum. But this gives you an idea of where you might fall. So as far as I'm concerned, our job at Trade with UFOs, Tradictive, is to, yes, show you a methodology in our courses. We do that, and you can follow that methodology if you'd like to the letter. But you'll notice if you look around the website, if you look at the courses, or if you've ever taken any of my courses, or maybe even joined me for some of my sharpening sessions in the past, my speciality, or the thing that I focus more on, are trade plans and back testing. Because yes, use the methodology that we teach. Yes, follow it if you want to in our coaching sessions, but not everybody is going to have the same risk tolerance level, which means somebody who is risk averse might trade the exact same strategy in the exact same way, just risk a little bit less per trade. Somebody that's more risk tolerant, exact same strategy, exact same way, risk a little bit more per trade. But also there might be, depending on where you're at on that spectrum, there might be other differences that you apply to the methodology, not just your risk percentage per trade. It might be, again, volatility, correlations, different rules. So as you're building your trade plan, these are the things that are subjective. These are the things you can say, okay, these are the rules, but my rule is if this happens, I'm going to do that. Why? Because I know myself. I know that I am more risk tolerant, and that making small profits, although risking small amounts, and it taking ages for me to see big gains, that's going to make me break my rules anyway, because you know yourself. So I'm going to do these things to appease my risk tolerance side. You might be somebody that's extremely risk averse that goes, rules are great, but I need to add more layers on top of that. I need greater probabilities. I need less risk. Great, do that. So we'll give you different ideas, different opinions, not because we want to confuse you, not because, I mean, for compliance reasons as well, of course, no one should ever be telling anybody what they should or shouldn't do when they trade, but it's true. An exact replica of a strategy that works for one person will not work for another. Almost no one else will work with this trade plan that you have that works for you. Because what's the chances that another trader has the same money in their account, has the same time of day that they're free, has the same frequency of time that they're free, has the same level of risk tolerance, thinks about risk and reward in the same way, has the same goals, and therefore wants the same amount out of the markets for different things? The chances that anybody else shares all of those variables exactly is extremely low. So they shouldn't be trading the exact same way that you do, and you shouldn't be trading the exact same way that they do. Can you share similar methodology? For sure. Can you trade on the same platforms? Yeah. Can you trade using the same technology, the same apps? Yeah. Should you be doing everything exactly the same way? In my opinion, no, because these are the kind of things that are subjective. We can use objective methodologies, apply them in a subjective way, so that we're more likely to actually follow the rules, and it's more likely to fit our timeframes, our styles, our thought process. So when it comes to percentages, if you're more risk averse and or new, less than 0.5%. If you are very risk tolerant and experienced, up to 2%. If you're somewhere in the middle, between 1% and 1.5%, roughly between them. Okay, so that is the percentages. Let's give that another red color. We've done that. So now let's talk about volatility. So let's say, and let me maybe pull up, I wonder if I can do, oh no, I know what we'll do. Let's go to here. Let's go to FX Street, because this is something we look at every day, and some of you might wonder why. Obviously don't have as much time in the, okay, yeah, let's select all of those. We don't have as much time in the market commentaries, and we've only got sort of 15 minutes to go through everything. we don't have as much time to explain everything. So what we look at every day on our 3D market commentary, we send an email out every day, Monday to Friday. Let's do this for that whole week. So we send out an email every day, Monday to Friday, with statistics and probabilities for major world markets. Now, on that email, we have a snapshot of this, which is essentially, this is the high impact news, meaning these scheduled news reports that are coming out on these different markets that may affect the stock markets or other markets in those countries and or their currencies. So if you trade Forex. Why do we care about that? Now, a lot of people will trade based on the news, meaning Bank of Japan says they're putting the interest rates up, therefore I'm going to do X, Y, Z on bonds there or on the stock market or on the currency, whatever. Or so-and-so, Elon Musk said something or did something, therefore I'm going to do this on Tesla or whatever. So a lot of people will try to interpret the news and make a buy or sell decision off of what the news is telling them. Now, we don't do that. We try and be more objective because interpretation of the news is extremely subjective. And although I was just saying we need to have trade plans that are objective but aligned to our subjective thought process, that's in terms of creating a set objective plan that says, because I know my risk tolerance, I risk 1%, stays the same the whole time. The way we interpret the news will change based on how we feel, based on our political lines, based on how hungry or tired we are. Deciding in creating our plan that 1% makes most sense for us and sticking to 1% becomes an objective behavior based on a subjective truth. Trading when interpreting the news will always be subjective behavior based on subjectivity every time. So we don't necessarily do that. We trade based off what are the probabilities telling us, based off of data, based off of apps, based off of technology. So why do we look at the news then? Why are we sitting here with the economic calendar up, looking at news reports that are scheduled to come out? Why are we only looking at high impact? Because we want to know which scheduled news reports are likely to increase volatility, meaning make that market move quicker, move further in shorter periods of time. Why is that important? Because if price moves quickly, so let's say news comes out and this market drops like that in minutes, for those of you that might have been watching the British pound during the Brexit years, that was a volatile market, jumped up and down a lot in the space of minutes based off of what was happening in Parliament around election times, right, in the States or anywhere. Again, we're going to see volatility. We're going to see big jumps. Now, let's say it goes from here to here in the matter of minutes. Or maybe even if we have a stop, it's moved too quickly. There weren't enough buyers or sellers, whatever it is, at that price point. We have to actually take our loss further than we wanted to. So volatility can increase our risk. Now, nearly everything that increases your risk can also increase your reward, right? So let's say we bought here and we want it to go up and high impact news comes out that means that it does go up quickly, then great, you've hit your profit target quicker and or made more profit than you wanted to make because you couldn't get filled at your target price. You got filled further than that. Brilliant. But that's obviously not great from the other side of it. So coming back to our economic calendar, depending on where you're at on this spectrum, if you are, again, newer and or risk averse, this is where you might look at this and you might say, okay, Monday night at 9:30 p.m. Eastern time, there's news coming out that might affect the Australian markets or the Australian dollar. And then Tuesday, we have early hours of the morning US time or Eastern Standard Time. We have news coming out that might affect the British pound or British markets. Then we have news coming out later on in the morning that might affect the Canadian dollar or Canadian markets. Then we have news coming out that might affect the New Zealand dollar or Kiwi markets. So let's say you're trading Forex. Perhaps you say, well, for Monday and Tuesday, if you're risk averse and or new, I'm not going to trade any currency pairs that contain those currencies. So you avoid it entirely. You don't even trade those markets that could see volatility based on expected news reports that are likely to have a high impact. So that's one thing you can do. Just avoid them entirely. Let's say you trade stocks, and you trade stocks in Australia. You might say, well, I'm not placing any trades on Monday, which would actually be, I guess, Tuesday morning in Australia. So maybe you say I'm not trading Tuesday. Maybe you trade in Britain and you trade British stocks. Maybe you say, do you know what? I'm going to keep out the stock market until after that news comes out, give it a bit to calm down, an hour or two, and then trade stocks that day. So the risk averse thing to do is to completely avoid any markets, be that stock markets, be that, again, let's say it's an announcement that might affect energy laws, right? Maybe you don't trade futures contracts of the energy sector. So you can completely avoid them and either don't trade at all that day if that's the only thing you trade, or choose to trade something else. So that's the risk averse thing to do. The extremely risk tolerant thing to do, so if you're on the other side of the spectrum, is to say, don't care. I'll place my trades anyway. I'll put my stops in. If I take a bit of slippage, meaning I get stopped out for a greater loss than I wanted to, so be it. I'm willing to take that because I'm also accepting that I might get slipped on my target and make more than I was willing to make. So I'll take that, take those odds. Either way, completely ignore it. Maybe you don't even look at this. That could be a thing. Somewhere in the middle might be that you say, okay, maybe I'm a currency trader. I will trade the Aussie, and I will trade the pound, and I will trade the Canadian dollar, and I will trade the New Zealand dollar if I see that it aligns with my other rules. But I won't double up. Meaning, I won't trade a pound New Zealand and an Aussie New Zealand, because then I'm trading the New Zealand dollar twice. So I'm doubling up my risk there. So I won't do that. I will trade maybe the pound New Zealand and the dollar yen, right? Something that's unrelated to this at all. Or the euro Swiss. So if I find an opportunity in this, I will, but I won't trade the same currency twice. So you're not exposing yourself to too much volatility, just a little bit in one of your trades, maybe two of your trades. That's a middly place to be. Another middly thing to do would be to say, okay, if I normally risk 1% on my trades, well, then for the ones that I see that we've got volatility coming out on, I'm going to risk 0.5%. So coming back to our spreadsheet, so when it comes to volatility, so again, we'll put this in. So we have risk averse, and on new, we have, put that back there where it already fits. We've got the middle ground, and we've got the risk tolerant versus experienced. So when it comes to volatility, let's just highlight this now. When it comes to volatility here, you can avoid all volatile assets. That can be something that you do. Let me just do this so we can do that. So you can avoid all volatile assets. If you are risk tolerant, you can ignore news and volatility predictions. You can do that. Those are the two ends of the spectrum. So somewhere in the middle, and let's make this a little bit bigger as well so we can see this. Somewhere in the middle may be lower risk on volatile markets or volatile assets. So instead of risking 1%, you risk 0.5%. Instead of risking 2%, you risk 1%. Instead of risking 0.5%, you risk 0.25%, right? You're just risking less on those trades. And or limit amount of volatile trades. Not done the thing on this very good, but hey, these are the ways that you could deal with this if you're somewhere in the middle. Lower the risk on the assets that could be volatile based on news that might be coming out, and or volatility stats. You could use that. And or limit the amount of trades that you place there. So maybe if you trade in different stock markets across the world or in different sectors, and again, perhaps the energy sector has got a lot of news coming out over the next couple of days. Maybe you say, I would normally trade oil and natural gas and stocks for gas companies, as well as other things. Well, I'll tell you what, I'm only going to place one trade in the energy sector, and I'm going to focus otherwise on financial sector or something else. So again, those are the different ways that you can deal with it if you are coming at it from different perspectives in terms of volatility. Okay, so that's what we do when it comes to volatility, depending on where we're at on that spectrum. So now let's look at correlations. So we kind of already talked about this a little bit. In general, correlations means, for example, trading the ES as well as the NQ as well as the YM, right? So you're trading US stock indexes, or stocks within those. So for example, FANG stocks. If you're trading FANG stocks and you're trading each of these, then you're kind of doubling up on your risk because you're trading kind of the same thing multiple times. They might be a different symbol, they might represent slightly different things, but a lot of the stocks that sit in the S&P will sit in the NASDAQ. They'll sit in the Dow, they'll sit in the Russell. A lot of the FANG stocks are going to sit in these. So if you're trading Facebook and Amazon, for example, and you're trading the ES and the NQ, you're kind of exposing yourself to the same thing 4 times. So again, the risk averse thing, and this is also true, by the way, if you're trading, say, the euro dollar, the pound dollar, the Aussie dollar, and the dollar Canadian, for example, you're trading the US dollar 4 times. Yes, it's against different things, but an announcement in the States that affects the US dollar will affect all of these things, probably in a similar way. An announcement that affects Facebook might affect all of these things. Maybe not exactly, but in a similar way. So the risk averse thing to do would be avoid correlations entirely. If you trade the US dollar, don't trade the dollar again, don't trade the euro again. So maybe you end up trading the euro dollar and the pound yen and the Aussie New Zealand and the, what's left there? I'm going to rack my brain here. To be Swiss something Swiss. I'm missing that, but anyway, Swiss, whatever it might be, Canadian. There you go, Swiss Canadian. I think it's catch up. So you might trade those 4, for example, because you're not doubling up on any of those currencies, meaning you are, again, you're missing out on the risk. So you're avoiding the risk of trading the dollar 4 times. But let's say there's volatility on the dollar that goes in the direction that you'd expected. You might have missed out on winning 4 times. That's the balance here, which is why the risk tolerant people might say, I don't care. They are still slightly different, but I'm pretty happy with my dollar prediction, and I'll take all of those dollar trades. And if I lose them all, lose them all. If I win them all, great. And that's what they'll do. So the risk tolerant, again, might be to ignore correlations as a rule. So don't even care. Again, somewhere in the middle, I tend to be a person that's somewhere in the middle, might be that you reduce risk on correlated trades, and or you reduce exposure to correlated trades. So what does that mean? What that means, let me just put this up here, make it a little bit nicer. Let's do that as well. Lovely. So what does that mean? That means that instead of trading only uncorrelated markets or being fine to double up as much as you want, maybe you trade the euro dollar, the pound dollar, the Aussie New Zealand, the Aussie Swiss, the euro yen, the, oh, you've already got the euro there, and then maybe what, the pound yen, for example. Okay, so you've got the dollar twice, you've got the pound twice, you've got the euro twice, you've got the Aussie twice. And then you could have New Zealand Swiss, I guess, and double up twice. But you're not trading them 3, 4, 5 times, just twice. So again, somewhere in the middle. And or what you could do is say, I normally risk 1%, but if I'm going to place dollar trades 4 times, then I'm going to reduce my risk by half, maybe on each. Or by, have 25% on each, right? So overall, you're risking 1% on the US dollar, despite it being across different trades. Or you could say the trades are correlated, but not so correlated. So instead of 1%, I'll risk 0.5%. I'll trade 4 of them. So that's risking 2% overall. I'm okay with that. That's better than risking 4% overall. So again, somewhere in the middle, depending on the percentage risk that you're willing to place and or the amount of trades that you are willing to place that correlate with each other. So again, that might be, to give you an example, when it comes to futures or stocks, for example. So you might say, well, instead of trading the ES, the NQ, and the YM, a risk-averse person might say, well, I'm going to trade the ES, crude oil, and maybe something that's completely unrelated to that. I think of the top of my head, maybe orange juice. I'm not sure if it's OJ, I can't remember. 3 things that have almost nothing to do with each other, right? Or lean hogs or whatever, bonds. So you could end up just trading different futures contracts that have nothing to do with each other. You could trade one FANG stock, and then you could trade small cap, and you could trade international, for example. So you could still be within the stock sector. That's not the sector, the asset class of stocks, but maybe mix it up by sector, mix it up by, again, by different countries, rather than all US, all FANG, all technological stocks, right? That are all going to move more or less roughly the same. So different ways of looking at it, again, depending on how risk averse you are. Now, again, as I was saying, what this does is it doesn't mean that we pick and choose on the day. It's not a subjective methodology. It will become an objective methodology, but you need to subjectively decide this to go in your trade plan. So for example, you might say, let's get rid of this one here and do this. We've done all of them. We'll come to rules in a second. You might say, having thought about these things, where am I in terms of risk tolerance? You might say, I'm in the middle. And my version of middle is I risk 1%. I don't double up on volatile trades. I'll double up on other trades, but only twice. And those are your rules. So every time you come to that, you have a set of rules that tell you this is what you do. Not one that you sometimes go, I'll risk 1% on that one. I'll risk 0.5% on that one. How do I feel today? Oh, I kind of do want to double up today, so I double up. Oh, I don't want to double up tomorrow, so I won't do that then. That becomes a subjective and a, what would be the word? It's an all over the place strategy. It's very hot today, by the way. I can't think straight. I can't think of my words, but you know what I mean. It's a strategy that becomes completely inconsistent, which means the results are inconsistent. And then how do you know what's working for you or what to tweak or what to change if all your variables are changing all the time? Whereas if you say, in creating your trade plan before you trade, ideally, at all, you're looking at it and you go, okay, I'm risk averse. I know I'm in that camp, which means I risk 0.5% on every trade. I will not trade in the markets or in the countries that show me that they're likely to have volatility based on an economic calendar or volatility figures. And I will not double up. Them's the rules, always. You could say, I'm risk tolerant. So I'm going to risk 2% per trade. I don't care about volatility. I'll take those risks, and I'll take the correlation risks as well. Because although I might be wrong sometimes and I might end up with more losses, when I'm right, I'll end up with more profits, and I'm okay to take that risk personally. I would be comfortable with that. Not necessarily me, I'm being this person. And again, you might say, no, I'm in the middle, which means I do this, this, and this. But then every time you're looking at the markets and you're faced with a choice, you've got an objective set of rules now that tell you what to do that were created based on your subjective reality. So hopefully that makes sense. Now the last one then, rules. How might this change depending on how we feel about risk aversion or risk tolerance? Now, let's quickly come here. I'm going to add my UFOs to this. Yep. Brilliant. Okay, so obviously, if you're not trading with our methodology, there are thousands of different ways, if not millions of different ways that one could trade. You can have loads of different rules or combinations of rules. Some people don't have any rules at all. They just press buy and sell based on whatever. And fine, right? Each to their own. But I'm going to show you, obviously, based off of our rules, to show you what you, in theory, could drop, what you could add, depending on where you fall in that spectrum. So let's say, so with our rules, just to give a very quick kind of lowdown of them or quick reminder of them. Let's see if I can find this chart text. I'll write it in here. So the first thing is that the auto climate needs to be confirmed either up or down. That's the first rule. If that doesn't happen, we don't even do anything else. Auto climate needs to be confirmed either up or down. Now, I know there are sub rules within this that might be to do with sustainability stats or anything like that, but let's just be really basic about it and we'll go from there. The second rule is that a correlating UFO must be present on the edge time frame, so the smaller time frame. And the third rule is that EMA from common time frame, which is the bigger time frame, must coincide with UFO on edge time frame. Okay, so just as a general rule, them's the rules, right? That's what we're doing, that's what we're looking at. So with this, let me see if I can just make it bigger so it's much easier to see. That's maybe now too big. Let's do it again. I want you to be able to see it, but obviously not if it goes off the screen. Okay, so we have those three rules. And again, I know we have sub rules within this in terms of, you might say auto climate confirmed either up or down, but if the sustainability stats are usually goes up for 7 candles and it's been going up for 8 or more, then I don't look at it. Again, that's a subjective rule, but the kind of core rules that we have got to be confirmed either up or down. Let's say in this case, confirmed up. Oh, actually, it's not confirmed. Sorry, that's an unconfirmed climate, which means we wouldn't even trade this. Let's assume it was confirmed up. Then we'd look at the correlating UFO on the right-hand side. So do we have green UFOs? Yes. If we do they coincide with the EMA price on the left? Yes or no? If it does, place the trade. If it doesn't, don't. It's kind of 3 main rules there. Again, there are extras, of course. So how could you be more or less strict on this? You might say, let's get a line here. So let's say you are the risk tolerant version. You might say, I don't care about that one, right? I'm just going to go confirmed either up or down, and then I'm just going to place it at the closest UFO or every UFO that correlates with that on the right-hand side. And that's it. Nothing else. What happens there? You place more trades, right? Because you have less barriers in the way, less criteria boxes that need to be ticked before you get into a trade. But probably the chances of those individual trades working out are less than if you have more criteria they need to hit in order to be placed. So that might be one idea, is that you are, let me see if I can erase that. Oh, it's not that one. I'm trying to erase it. Must be an easy way to do this. I think I'm just trying to, oh, there we go. I can delete it. Brilliant. So let's say you are the risk tolerant. That might be where you say, I'm not doing that one. And or I just want the EMA, not the UFO. Now let's say you are more risk averse. What are the different things you can do? So many different things. Say these same rules, you can be adding all kinds of things on top of it. So you could say, as well as the auto climate being confirmed either up or down, you could also say sustainability needs to be less than X percentage of its usual. So let's say if it's usually 7, you could say it's got to be 5 or below. If it's usually 8, then it's got to be 6 or below, whatever. You could also say correlating UFO must be present on the edge time frame. You could say that those UFOs also have to have a percentage probability of more than 50%, 60%, 70%, 80%, 10%, 20%, whatever. The more risk averse you are, the higher that number is going to be. The more risk tolerant you are, the lower that number is going to be. But again, you can layer that in as an extra rule. The EMA from the common time frame must coincide with the UFO on the edge time frame. You might say, not only do I want the 9 EMA from the common time frame, but I also want the 14 or the 20 or the whatever to coincide as well. And if it doesn't, I don't place the trade. What happens there? You place less trades, a lot less trades, because you've got more barriers, more criteria that's got to be hit. So less likely that there are trades that hit that criteria if you have more criteria. But in theory, the trades you're placing are going to have a higher probability of working out. Now, what's right or wrong here? Neither of them. And let me prove to you why. In terms of what ultimately makes you more money or not, who knows? And let me explain. So I'm going to copy and paste this so we can see. So let's say, and this could be over the course of a year, over the course of a month, over the course of a day, a week, it doesn't matter, whatever time frame you want it to be. I'm going to say over the course of a year, just as an example, but it's obviously going to depend what style of trade you are. So let's say here, in fact, let's get the 3. Here we'll have risk averse. Here we'll have middle. And here we'll have risk tolerant. Now, let's say then, if you're risk tolerant, you can place 100 trades in a year because you have more opportunities to do that. If you're risk averse, maybe you can only place 30 trades in a year. We'll come to that in a second. Let's say in the middle, you can place 70 trades a year. Okay. Now, let's say if you're risk tolerant, your winners are making an average of $30. Sorry. Your winners are, this would be out of 100 trades, your winners are 30%, which means your losers are 70%. Let's say in the middle, you're out of 70 trades, let's say again, 30 of them are right, 40 of them are wrong, but you've got a better percentage rate there. In fact, let's do this as a percentage. So I'm going to put, say 40% there, and we'll do this. Cool. And we'll do 30% here, just to make sure that we can see the percentages. And then let's say here it's 50%. Okay, so because you're more risk tolerant, you can place more trades, but maybe they have a lower percentage chance of winning. So don't make as much. Let's say the winning average is the same. So what you make when you're right is the same. What you lose when you're wrong is the same. So all that we're changing here, and of course that would change by more than these variables, but all that we're changing here are the probability that you're right and the amount of trades that you can place. So we've made these numbers up, but it's just to kind of show what it means. So let's say in the case of being risk tolerant, you've placed 100 trades over the course of a year, and you've made $100, pounds, could be 100,000, whatever the numbers are. You've made 100. Out of 100 trades, you've made 100. So per trade, you get $1 or 1% return, right? If you want to call it percentage. In the middle, you've placed less trades. So 70 trades instead of 100. So you're not trading as much. But out of those 70 trades, you made 560. So each trade is now worth to you $8 or 8%. So much more than being risk tolerant, and you place less trades. So maybe you go, well, this is better then. Not if doing this is going to be something that makes you as a person impatient, getting involved in your trades when you shouldn't, not following your rules, still making money over here. If that keeps you busy because that's your main target, keep doing that. Maybe the risk averse side, they've only placed 30 trades in that whole period of time because they're much more strict on the criteria that needs to be hit. But they've got a 50% chance of winning their trades, which means ultimately out of 30 trades, they made 450%, dollars, pounds, whatever you want. So they made less overall than the people in the middle. Each trade was worth a lot more to them, much more efficient use of their trading. But overall, they made less than the person that placed more trades with slightly less efficiency. And you could, if we change these numbers a little bit, you could, let's just say that becomes 38%, just for me to make my point. You could say, well, the risk tolerant person, they have placed 100 trades. They've got 38% chance of winning. So less than the others in terms of probability chance of winning. But overall, they still made more money than those that were more risk averse. Now, per trade, they made less. It was a less efficient way to make the same amount of money, but they made more money because they placed more trades. So those things are always going to balance. What you make when you're right, what you lose when you're wrong, how often you can be right, and how many trades you place. Those 4 numbers, and you can put them together however you put them together, are going to ultimately tell you what you're profiting and losing. Which of them is right, couldn't tell you. Depends on you. Because you might say, well, whatever makes me the most money. So if it's that one, it's that one. Might be less efficient, but I'm making more money because that's my goal. And I'm okay to only be right 38% of the time and be wrong, 62% of the time? Or you might be the other side and say, no way am I comfortable being wrong 62% of the time. No way. I want to be right at least half of the time. And if that means I place less trades and I've got to be more patient, and I might go weeks where I don't place any trades and I'm looking at the markets every day, but my criteria isn't met and I don't place any trades, I'm okay with that. And I might make less money overall, but each trade that I place is so much more valuable, way more efficient way to make that amount of money. And I didn't have to lose a bunch of times in a row to do that. You might say I'm somewhere in the middle. I want to place a reasonable amount of trades. I'm okay to be wrong 60% of the time. I can be right 40% of the time. That's okay. I still make somewhere in the middle and my trades are reasonably efficient. Doesn't matter which one you pick, but pick one. You can't sometimes have a week where you go, screw it. I'm going to place as many trades as I can. I'm going to be more lax on my rules. Place more trades that have a lower percentage chance of winning. And then the next week, so I'm going to risk more or risk less, put less trades on, add more rules, take more rules away. And then the next week, do the opposite. That's when it's like running a business, but changing your mind every week. It's like running a business, but changing your prices every other day and wondering why you're not consistently making the same amount of money without any data to actually know what's working, what your customers would actually want to pay. It's like changing suppliers every couple of days. And again, wondering why you can't keep track of why your business might not be working, right? We need to have consistency with what we're doing. And it's okay to pick any of these, but pick one, stick to it. Pick one based on, as I've explained this, there'll be some of you that go, no way would I do that. I'm over here. Some of you that go, I can see the value of both. Probably somewhere in the middle's right for me. Probably some of you that go, as long as I can make the most money, I don't care, I'll do that one. Fine. Up to you to pick, but pick. Be consistent with it. Incorporate it into your trade plan and let it become an objective plan. If this, then that. If this, then that. People over here are going to have less of those. It might be if this and this and this, then that. If you're over here, then it might be if this and 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 this, then that. Okay. Both are objective. Both are following rules that are not subjective once they've been put into that plan. They're just, one of them stricter than the other. One of them has more rules than the other. Might not necessarily save more money or make more money. Depends on how these numbers play out. But it's about what makes it comfortable for us to consistently be trading in the face of the reality of the markets. So let's kind of come to a nice end there. So we've looked at, now, depending on where you're at on this spectrum, we've looked at the fact that we always use stops. That does not change. Where you put them is up to you depending on your methodology. If you are finding that you are getting stopped out despite being right on the direction of the markets, you're putting your stops in the wrong place, research that, look into that, find other places you might be able to put your stops that give you protection against being wrong, but wiggle room to be right. Percentages, if you are more risk averse, you risk less, about 0.5% per trade. If you're more risk tolerant, you can risk up to 2% per trade. If you're somewhere in the middle, then somewhere in the middle. When it comes to volatility and scheduled news reports that could increase volatility, if you're risk averse, you will avoid volatile markets or markets that might see volatility. If you're risk tolerant, you won't care. You'll trade them anyway. If you're somewhere in the middle, you might reduce your risk on trades that have high impact news coming up, or you might just make sure that you don't double up on trades that have high volatility coming up. When it comes to correlations, if you're risk averse, you will not trade two markets at the same time that are correlated with each other because you're increasing your risk. If you're risk tolerant, you will and you won't care. Yeah, I'll trade the ES, the NQ, Facebook, Amazon, Netflix, Google, YM. I'll trade them all. Doesn't matter because they're correlated but not the same thing, so I'm happy to do that. And if I'm wrong and all of them lose, so be it. If I'm right and all of them win, brilliant. I'm happy to take that risk. Or you might be somewhere in the middle that says, I'll only double up twice. Or I'll double up as much as I want, but for each time I do that, I will reduce my risk percentage by set amount. Rules. If you're risk averse, you will have more rules, more criteria before you're allowed to place a trade. If you're risk tolerant, you will have less rules, less criteria before you take a trade. If you're in the middle, somewhere in the middle. Either way, you're going to have set rules that tell you when you can and cannot take a trade. Risk tolerant people are still going to have to follow an objective methodology. They'll just have less criteria. So that's the overview there then of what we can do depending on where we're at in risk management, depending on where we're at on the spectrum. What can we do in different situations? What does that mean in terms of the choices we make? What does our subjective reality do to our objective trade plan? And how would that play out in real life? Now, if you have questions, you can email me. I'm always happy to help by email. Becky@tradictive.com is my email address. If you go to tradewithufos.com/Becky, which is here, in this area, so it's at the bottom. So if you just go to that link, you'll come somewhere near the top and you'll see all this stuff. If you scroll down right to the bottom, which is the question and answer section, if you post a question in here, because you're posting it publicly, I can then use that question and do a sharpening session about it. So if you'd like a bigger, longer, dedicated video to your question, then by all means post it here. It kind of gives me permission to do that. So today is Saturday, so I wish you guys a great rest of your weekend. I will see you next week. Hopefully this made sense. Hopefully it helped to clear up some confusions that people might have. If it's created any extra confusion, reach out to me. Always happy to help and clarify. And I will speak to you guys soon, or I'll see you guys soon. Take care. Bye-bye.